Well, hello everyone and welcome to Momentum channel. My name is Mo, and in this video, we're going to be talking about two undervalued dividend paying stocks that are in information technology that are perfect for dividend investors to get in. Both of these stocks are currently trading at or close to their 52-week low prices, and we believe that based on the fundamentals and their financial investigations research, they are perfect choices for investors. So let's get into it.
What I could buy with that money. Now it's down $200. Up again!
The very first dividend-paying stocks for us to review is a company called Corning. Corning, as indicated, is in information technology, and it's traded on New York Stock Exchange with ticker symbol GLW. It's an electronic components company that engages in display technologies, optical communications, environmental technologies, specialty materials, and life sciences businesses worldwide. The company was formerly known as Corning Glassworks and changed its name to Corning in April of 1989. The company was founded in 1851 and is headquartered in Corning, New York. You notice that this information technology company does pay a dividend yielding 2.74%, which is quite decent, especially knowing that many information technology companies either don't pay a dividend, or if they do pay a dividend, their dividend is quite low. So 2.74% dividend yield is quite decent. It has a dividend safety score of 77, making it a safe dividend payer. Corning has a market capitalization of $29.9 billion, making it a large cap company. The last time the company increased its dividend was in February of 2021, where they increased their dividend by 9.1%, making it a fast dividend grower in that sense. From a volatility perspective, Corning stock has a score of 1.18. The beta score over 1 suggests that the stock is more volatile than the overall stock market. In this case, you can deduce that the company stock, GLW, most likely is more volatile than the overall stock market. Looking at a number of additional key metrics, the payout ratio for Corning is at 46%, and its forward price to earning payout ratio is actually at 44% too, which is considered to be low for most companies, giving the company a ton of room for increasing its dividend payments for the many years to come. The company has been paying its dividend without a reduction for the past 13 years. And if you look at it historically, in the past 5 years, they've increased their dividend annualized by 13%, making it a very fast dividend grower in that sense. And in the last 20 years, they've increased their dividend on average 7% per year. It shows an increase of average growth in that sense. During the recession years of 2007-2009, Corning had its sales down by 23.3%, which was below average growth during that time. And their return during the 2007-2009 was on 61% negative, which was worse than that of S&P 500's negative 55% stock return during that time period. So maybe it's not the best recession-proof company in that sense. But at the same time, we don't necessarily believe that we are heading for a recession anytime soon. From a dividend history, you notice while they have paid their dividend 13 years, the last 10 years, they have increased their dividend year after year. The company Corning pays its dividend quarterly in the month of March, June, September, and December. And currently, they have an annual payout of $96 per share. In terms of the valuation metrics, Corning's current dividend yield of 2.74% is 13% above their 5-year average of 2.43%, indicating that now could be a reasonable time to invest unless you believe that the company's outlook has weakened. What's more, their forward price to earnings ratio of 16 is about in line with their own 5-year average of 17. And it is better than that of information technology, which is at 19.5. A very other point that we wanted to bring to your attention is around the 52-week price range. You look at it, in the last trading day, the stock actually hit its 52-week low price. So it's as good as it could get in terms of the price volatility, at least over the span of the past 1 year. This could provide a wonderful opportunity for investors to get in. And we're going to take a look at a number of additional financial metrics. We're not just going to base our decision off of merely the 52-week price range for the stock. Earnings per share is one of those key metrics that we would look at when it comes to analyzing the stocks for different companies. Ideally, we'd like to see an earnings per share that steadily and continuously grows year after year. While it's not exactly the case, and we see a little bit of that cyclicality and ups and downs, For the stock, the last 12 months, the company has had $2.06 earnings per share, which is the highest that they've had in the past 10 years. What's more, in the next 12 months, it is expected and anticipated for them to have earnings per share of $2.19, again, the highest that they've had in the past 10 years. As for outstanding shares, we'd like to see the company that continuously declines the number of outstanding shares. Of course, it's specific and dependent on the sector that they're in, but more or less that would be the ideal scenario for us. And it is somewhat the case. While they had the lowest amount of outstanding shares in 2020 with 772, the last 12 months, they are showing 824 million outstanding shares, which is still less than what we saw about 10 years ago back in 2011. It almost doubled the amount of outstanding shares in the market. The total sales or revenue for the company, we'd like to see them steadily growing that. It's almost the scenario here where the last 12 months, they having $13.8 billion in total sales, which is much better than that of what they've reported in the past 10 years. In terms of return on equity, for companies, generally, we'd like to see this above 10%. And in the last 12 months, the Corning is showing 13% return on equity, which definitely passes this metric. All right, now let us take a look at the stock return for Corning in the past 1 year and the past 5 years and see how they've done in that time frame. If you look at the past 1 year, the stock is down by 8.84%, but in the past 5 years, they are up by 31.4%. Next, we're going to take a look at analyst estimates. Analysts on TipRanks, we have 9 of them covering the stock, 5 of them have a buy rating, and 4 of them have a hold rating, with the average price target for 1 year being at $44 US. If that holds true, that shows an upside of 25.5%. Analysts on Yahoo Finance have a similar price target, close to $44 at 44.08 cents to be exact. And lastly, analysts on Simply Wall Street, covering the stocks from a valuation perspective, give the stock a fair value of $45.14. Based on that, the stock is undervalued by 22.3%. Well, there you have it, folks. So far, we've covered the very first undervalued dividend stock that is hovering close to its 52-week low price. Before we move on and take a look at the second undervalued stock, I have a big favor to ask you. I've put a ton of time and research to put this video together to bring value to you, and I hope that you appreciate it by giving this video a thumbs up and sharing it with someone who might benefit from the video as well, and subscribing to our channel. Thank you. Let us take a look at our second pick. The second company is Visa. It's another information technology, data processing, and outsourced services company that operates as a payment technology company worldwide. It is renowned throughout the world, and they do facilitate digital payments among consumers, merchants, financial institutions, businesses, strategic partners, and government entities. Visa has a dividend safety score of 99, although their dividend is quite low relatively at only 0.73%. We did point out that information technology companies tend to pay lower dividend overall. They did increase their dividend by 17% last time in October of 2021, making it a very fast dividend grower. Visa has a market capitalization of $434 billion, making it a mega cap company. And lastly, in terms of the beta or volatility score, they have a score of 1.09, slightly over the score of 1, suggesting that Visa's stock is more volatile than the overall stock market. Looking at a number of additional key metrics, the payout ratio for Visa is at 23% and their forward payout ratio is 21, both of which suggesting very low for most companies, giving them a ton of room for increasing their dividend. And look at that. In the past 5 and 10 years, the company has been increasing its dividend very fast. In fact, the past 5 years with an average annual increase of 18%, and in the past 10 years with an average annual increase of 23% for their dividend amounts. Looking at the annual dividends overall, the chart shows you that, and the company has been paying a dividend for the past 13 years, all of which they have increased their dividend year after year. Visa does pay an annual amount of $1.50 per share, and their dividend is paid in total on a quarterly basis in the months of March, June, September, and December. In terms of valuation, Visa's current dividend yield of 0.73% is 16% above their own 5-year average of 0.63%, indicating that now could be a reasonable time to invest. Furthermore, their forward price to earnings ratio of 29.3 is close to their own 5-year average of 29.1. Hence, the market appears to be valuing the stock similarly to how it has in the past. It is higher than that of information technology, forward price to earnings ratio of 19.9 though, which most of the time could suggest that the investors are much more optimistic about this firm compared to the overall information technology sector. We had mentioned that we are looking at the stocks that have their prices close to their 52-week low prices. And in fact, that is the case. The last trading price of $205.93 is quite close to that of the 52-week low price for the Visa stock, which was at $190.16, with their 50-week to high price was at $250.93. Let us take a look at additional financial metrics. Earnings per share, they are nicely increasing it year after year. In 2020, it was a little bit of decline, but other than that, they are showing that nice steady increase. The last 12 months, they are showing $5.91 earnings per share, with the next 12 months expected to be at $7.02, which is just remarkable. Outstanding shares for the stock is gradually declining, which is a nice thing to see for us. The last 12 months, they are having $2.19 billion in outstanding shares. In terms of total sales or revenue, they're increasing it nicely year after year, again, with that exception of 2020, which was a little bit of decline, with the last 12 months reporting $24.1 billion in total sales. Lastly, in terms of return on equity, they are well over 10% mark for the return on equity, and in the last 12 months, showing 33% return on equity. Return on equity is a measure of how many dollars of a profit a company earns for every dollar that shareholders have invested in the firm. Let us take a look at the stock price return. In the past 1 year, the stock is only up by 2.46%, but keep in mind that in the past couple of weeks, the information technology and NASDAQ as a whole has had huge pullbacks, and in fact, it has had a correction, given the fact that the NASDAQ's overall has been down by over 10%. That definitely has impacted companies such as Visa, that is in information technology, showing only 2.46% 1 year return. The past 5 years, though, Visa has knocked it out of the park. It's still showing a massive 145.8% stock price return. Let us take a look at analyst estimates. Visa has 15 analysts on tip ranks covering the stock. 13 of them have a buy rating and 2 of them have a hold rating, giving it a strong buy rating. With the average price target of $265.80 in 1 year, giving the stock an upside of 29% plus. With analysts on Yahoo Finance having even a more aggressive price target of $269.33 in 1 year. And lastly, analysts on Simply Wall Street assessed the fair valuation of the stock to be at $243.68, suggesting that stock is currently undervalued by 15.5%. There you have it, folks. A quick look into 2 undervalued dividend stocks that are in information technology sector, and both of them are trading close to their 52-week low price. I hope you found this video beneficial and gained something of value from it. If you did, don't forget to give this video a thumbs up and share it with someone who might benefit from the video as well. And of course, please subscribe to our channel. Here on Momentum channel, we post every week several videos about investing, whether it's investing in the stock market, cryptocurrency, as well as real estate, as well as finding ways to reach financial freedom. Thank you, and I hope to see you next time.